Hey everyone, welcome back to another SoFi update. In today's video, we'll go over SoFi's earnings report, both the good and the bad from it. I'll look at some important points that a lot of people are completely missing, and I'll give you my honest opinion about the stock right now. I had said last week that this earnings report could be one of the most important in recent years. SoFi actually delivered a record-breaking quarter, but the stock dropped about 15%, and today we've just had the first Wall Street Analyst price revisions. And to be honest, it's not good. So let's get straight into the video. First of all, this morning, Needham analyst Kyle Peterson has been the first to jump in with a SoFi revision. They have lowered their price target quite considerably, from $33 down to $25. And although they've lowered their target, they have still issued a buy rating. And this is quite considerable because most analysts have covered this stock in the past month or two have usually given the stock a hold or even a sell. So that's interesting, but the details in the earnings report will show us exactly why they have done this. In the early hours of Wednesday morning, I posted my SoFi prediction on X. My predictions were simple based on the information that we've gotten over the past few months. I predicted that they would beat on revenue and EPS. My own expectations is that they would deliver 1.1 billion and EPS of 14 cents. While I expected membership numbers to increase to 14.7 million and products to 21.7. A couple of hours later, SoFi delivered some great results. They delivered exactly what I expected on revenue of 1.1 billion, exactly what I expected on members with 14.7 million. And here we can see side by side my prediction and the actual financial results. I actually underestimated their product growth. My estimation was 21.7 million. They recorded 22.2 million. And this highlights something that I've talked about so many times, and that is SoFi's cross-selling strategy. You know, their membership numbers increased by 35% and the products increased by 39%. For me, this is very bullish. And when I see this, it reminds me that we're going in the right direction. However, SoFi falls down on their earnings, on their EPS, and some other important details that we'll see now in the earnings report and commentary. So let's dive straight into the earnings presentation. I'll give you my thoughts on the results, why the stock tanked, and what needs to change in order for SoFi stock to go back up again. First of all, as we've already seen, they recorded net revenue of 1.1 billion and adjusted EBITDA of 340 million. The adjusted EPS of 12 cents is the 10th straight quarter of profitability, and they have 1.1 billion in cash reserves. Financial services and tech platform revenue contributed over $500 million of adjusted net revenue, which is a 24% year-over-year increase. Record loan originations of 12.2 billion in the quarter. Total deposits grew 2.9 billion quarter over quarter and now stands at over $40 billion, while tangible book value is now 9.2 billion. We've talked about the rule of 40 plenty of times. SoFi has consistently exceeded this over the past 4.5 years, with Q1 2026 giving a score of 72. This is the third best score on record. Now, we've already seen the members and products growth, but it's worth mentioning that new members of 1.05 million and new products of 1.8 million are both record quarterly growth figures. And it's the same for net revenue, adjusted EBITDA, and adjusted net income. Each one is a new SoFi record. So why the hell did SoFi tank? And why are Wall Street analysts downgrading the stock? First of all, SoFi have chosen to not raise their guidance figures for 2026. Now, if you follow SoFi over the past few years, then you know that these are the things that always happen. They usually beat on revenue and EPS, and they raise guidance. So this is the first negative thing. Although this could be seen as a very prudent thing to do, this is what CEO Anthony Noto had to say on the matter.
Look, there was real strength in the quarter that you reported, and analysts are saying that time and time again, particularly in loan origination across the board. But, well, many are saying, look, you uncharacteristically didn't raise your revenue outlook. What held you back from doing that?
Yes, we had a record quarter. Actually saw accelerating revenue growth to 41% year-over-year growth and reported over $1 billion of revenue. Our view was we went into the year with a view that we'd have at least 2 rate cuts, and that was one of the key assumptions to our outlook for revenue guidance. And while we beat the quarter, we're not raising full year guidance because we now expect no rate cuts, and that will be a more difficult environment to operate in than if we had 2 rate cuts. The business is performing incredibly well. I'm not sure there are many companies that are generating over $1 billion of revenue with 41% growth year over year and 31% EBITDA margins. We like to look at the rule of 40, which is revenue growth plus EBITDA margins, and we've had more than a rule of 40 for 18 consecutive quarters, including this quarter, and we're still forecasting that. But we saw no reason to raise guidance in this environment given the uncertainty as it relates to markets and interest rates, as well as global issues with the Middle East and the pressure on oil and inflation generally.
The next thing is that the tech platform has not done very well this quarter. Revenue growth has stopped. In fact, it's dropped. Tech platform accounts are down from 168 million in 2024 down to 133 million right now. The revenue contribution has dropped about 30%, down to 75 million. And the contribution to profit has dropped from 48 million down to 12 million in a single quarter. That's a 75% decrease since December 31st. Contrast this with the lending segments. The margin, contribution and profit has increased from 56% in December to 61% for Q1, while the revenue contribution has gone from 486 up to $629 million, which is by far the biggest increase yet. Lending originations as well has increased significantly across personal loans, student loans and home loans, particularly student loans and home loans, which have more than doubled. This looks great, however, this causes a problem that nobody is talking about. Right now, SoFi is branded as a tech company. It's analyzed as a tech company, and it has valuation multiples like a tech company. A bank, on the other hand, is valued very differently, and although SoFi has a bank charter, it's still a tech company. But when the tech segment starts to drop and the banking, the lending, the loans sections start to take over, then SoFi starts to look more like a bank and less like a tech company. And then we see increased calls to value it like a bank instead of a tech platform. These are two types of companies that have completely different valuation models. Tech companies tend to be valued based on future growth, scalability, and future margins, and so PE ratios in the 30s or even the 40s are normal and to be expected. Banks, however, are valued completely differently. The price to sales ratio tends to be low single digits like 3 or 4, while the PE ratio tends to be around 10. And this poses a huge problem for SoFi. Because the more the company starts to look like a bank, then the more analysts are going to be valuing it like a bank. SoFi has a PE ratio of over 40, which is far above that of standard banks. Here we can see Bank of America, JP Morgan and Wells Fargo. They all have PE ratios between 10 and 15. If SoFi was to be valued as a bank, it would be seen to be trading at a huge premium and look extremely overvalued. However, when we compare SoFi to other tech companies, say like for instance Nvidia, Google or Robinhood, SoFi's valuation metrics look completely normal. As a fintech company, SoFi sits between tech and banking. But it's very important that it remains to be seen as a tech company more so than a bank. There is both good and bad to the current earnings call. The brutal truth is that SoFi has set itself up for much better quarters ahead. They didn't raise guidance for the year, but if they continue to grow like this, then they should easily beat the guidance in the coming quarters. But guys, what do you think?
Yeah, I think generally when you don't raise guidance, you give something, you give people something to worry about. So we had record personal loan originations, $12.9 billion, record student loan refinancing originations, and record home loans. And in fact, our home loans business doubled year over year, as did our student loan refinancing business. The loan platform business is one where we produce loans for other partners, and that business was very strong. It wasn't as strong as it was prior quarters because we made the conscious decision to put more of the loans we originated on our balance sheet because we had capital to do it. Those loans will produce cash flow over the next 3 years, as opposed to the loan platform business where we just generate revenue in this quarter. We're not seeing any issues with credit performance. It's been quite strong. The concerns about private credit are really not appropriate for our business. Our partners in the loan platform business are buying consumer unsecured loans from us, not financing companies with corporate debt.